How's everybody doing today? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about loan growth. How are banks feeling about loan growth going right now and moving forward? And we're going to look at a number of things today. I've got a few articles, and we're also going to look at the Federal Reserve's Senior Loan Officer Survey, which is a survey that the Fed runs quarterly among senior loan officers at hundreds, if not thousands, of banks across the country to try to get a feel for how are banks doing as it relates specifically not just to lending but all different types of lending, whether it would be what's called C&I loans, commercial real estate, consumer lending, residential mortgage lending. And so let's get into something here real quick. So the first thing I want to bring up is this is the Federal Reserve's website here. So this is the Senior Loan Officer Opinion Survey. Now I'm going to just hit a couple highlights, and then I actually like to look at the charts. So I'm gonna read just a couple highlights here, and then we're going to go look at the charts here. So respondents reported tighter standards and basically unchanged demand for commercial and industrial loans, in other words, C&I loans, to firms of all sizes over the second quarter, and tighter standards and weaker demand for all commercial real estate loan categories. So basically, commercial real estate loan demand has dramatically fallen here in the second quarter of the year. Banks reported unchanged lending standards and weaker demand across all categories of residential real estate loans, and unchanged lending standards and unchanged demand for home equity lines of credits as well. Standards tightened for credit card and other consumer loans, but remained unchanged for auto loans, while demand weakened for auto and other consumer loans, but remained basically unchanged for credit card loans. So, very interesting there as it relates to credit cards, because they have tightened the standards for credit card because you've seen the delinquency has been going way up. However, the demand for credit cards has remained unchanged because basically that's what the consumer is surviving on right now. So they've got to have it. What's kind of interesting with the auto is that you're also seeing the demand. They're also seeing the default in auto loans spike up as well. The credit standards have not really changed for auto loans. However, we have seen some weaker demand as it relates to auto loans. So just like I said, just some interesting things. So that's kind of the highlights of the report. But then let's go in and take a look at some of these charts real quick. So if you just click on the charts, it gives you a great little PDF of just all the charts that are within the report itself. So here, the first thing we're going to look at, these three charts are related to, this is measures of supply and demand for commercial and industrial loans by size of firm seeking the loan. And we can see here in the first chart that what do we have? We have, if we're looking to the far right here, we can see that basically the demand is falling back to basically zero or the break-even line. Not a great thing there. And then net percentage of domestic respondents increasing spread of loan rates over bank cost of funds, again, downward there. Percentage of net percent of domestic respondents reporting stronger demand for commercial and industrial loans. Now, this has actually gone up. It had plunged way down into 23, but now it is actually made its way back up. So you got loans to small firms in there, and also loans to large and middle market firms. So there has been some, a little bit of appetite there for C&I loans. So, and then the next thing we go on to is measure of supply and demand for commercial real estate loans. And here again, you can see, if we're looking to the far right, you can just see that the demand for commercial real estate loans has just absolutely plunged. And then, net percent of domestic respondents reporting stronger demand for commercial real estate loans. And that, and again, that's kind of come back up a little bit, but it's not even back to zero, basically. So we saw a huge plunge down, and then we saw it pop back up a little bit, but still hasn't even crossed back to zero yet. But yet the tightening standards for commercial real estate loans have definitely tightened up. Okay, and then we go on to measure of supply and demand for residential mortgage loans. So net percent of domestic respondents tightening standards for residential mortgage loans. And you can see that, yes, I mean, standards have absolutely tightened. Net percent domestic respondents reporting stronger demand for residential mortgage loans. It's kind of tepid here again. Just like with commercial real estate, like not even back to zero here. Measures of supply and demand for consumer loans. Respondents tightening standards on consumer loans. Yes, you can see this coming back down towards zero here. Respondents reporting increased willingness to make consumer installment loans, and that's come back a little bit. We're basically about back at zero there. And then respondents reporting stronger demand for consumer loans, and again, kind of popping back up a little there, but certainly not not very strong at all. So, okay, so that's kind of our senior lender survey by the Fed. And remember, this is a quarterly survey that comes out every quarter for the Fed. And if we just pop back for a second here and we pop back, so here are basically the release dates. So again, you got it every year here, 21, 22, 23, 24. And you can see basically every year it comes out basically January, April, July. The next one will come out in August or October as we head toward the end of the year here. So that is the Senior Loan Officer Opinion Survey from the Federal Reserve Bank. So now let's take a look at a couple articles here real quick. So this is from Bank Director. So more banks are reporting slowing loan growth, raising risk concerns for directors. Like it says, basically says boards need to understand that pressure to keep pipelines flowing could lead to credit-related headaches in the future. So there are increasing signs that consumer and business loan demand is slowing down. Directors should take note and prep questions for their management teams. A survey conducted by the IntraFi in early July found that nearly 40% of respondents had seen a decrease in loan demand compared to a year earlier. Several large and mid-sized banks warned during the second quarter earnings calls recently that appetite for loans has cooled, and a few community banks reported linked quarter declines in loans outstanding. Understanding why, like a key consideration for directors should involve understanding the underlying causes of decelerated loan growth. It could be reduced appetite by potential borrowers or concerned effort by bank executives to be more cautious. There is a mix of banks being careful and customer demand being somewhat limited. To that point, banks that did report linked quarter declines in outstanding loans had different messages during their quarterly calls. We've de-emphasized asset growth, said Edward Hanley III, Chairman and CEO of Washington Trust Bancorp, during the Westerly Rhode Island Company's earnings call. The $7.2 billion company, which reported a $56 million or 1% decline in loans from the first to the second quarter, instead is focused on building capital and adding deposits. And then it goes on to say, focus on lending officers. Like a big focus for directors should be on the bank's lending officers. Boards need to press executives to get a better understanding of how lenders are compensated, to emphasize solid underwriting and limit how many exceptions are made to land a borrower relationship. It can be tempting to compromise on loan terms when a portion of compensation is tied to a lender's pipeline. Boards should also ask management teams to discuss the lending deals they have been turning away and understand which competitors are picking up the deals and what terms are being conceded by those other lenders. And then it goes on to say basically enforce a disciplined culture. I got a couple of things I'm going to show you guys real quick, but I want to do a little bit of a sidebar for a second with kind of the lenders. So, lenders never get compensated for the money that they save the bank by not doing bad loans. And I've always found that very, very interesting because, again, lenders are salespeople. They are there to develop loans. They're there to make sales, to bring loans in, put loans on the pipeline, because banks have to put new loans on the books every single year because you have what's called runoff. Loans. If in other words, if you start off with a portfolio of loans, you're going to have customers that are going to make payments on those loans all year long. So at the end of the year, you're going to have a lower balance. You're also going to have some number of customers to just come in and pay loans off. Could be somebody died. Could be they're looking to retire and they're just paying off the mortgage on their house. Could be somebody got divorced. Could be somebody took a new job somewhere, had to sell their house and paid their loan off. Could be a whole myriad of reasons as to why you get X number of payoffs. Could be a big refinance boom going on. But in cycles like these, you get a lot of what's the old saying? You gotta kiss a lot of toads before you find a prince, like, so to speak. And that's kind of what it's like right now in this lending environment. You got to look at a lot more deals and comb through a lot of deals, and look at cash flows and examine financials before you can basically sit there and say, you know what, yeah, this one's not too bad. We could this one's at least solid enough that we could move forward with this. This has got a decent chance of going through. But like I said, banks, you might look at 20, 30, 50 loans before you get to that one decent one. And obviously all the ones that you turned away, it wasn't that you just turned them away because some other competitor was picking them up, is that you turned them away because they were bad deals and they didn't work. And so, but again, lenders, like I said, they don't get compensated for the money that they save the bank by not doing bad deals. So, and that's why at the bottom here at this article, it said basically like, reinforce, a disciplined culture, basically like, yeah, stay disciplined in your underwriting practices. That will prevent you from basically doing bad deals in a bad cycle, like what we're in right now. So, okay, now all right, that's that. So let's take a look. Two other articles real quick. So this is from the business journals, and it says, banks tightening lending standards, increasing pressure on small business owners. Small business owners are being told to brace for a continued squeeze as banks further tighten their lending standards in the current economic environment. The tightening was detailed in the latest Senior Loan Officer Opinion Survey. The research spotlighted the second quarter found for commercial and industrial loans in particular, banks tightened their standards at a time when demand for loans was unchanged. Banks also tightened their lending standards for commercial real estate loans despite weaker demand for such loans. The second quarter activity comes after a first quarter when banks reported tightening their lending standards as well. High interest rates are playing a role in decisions being made by both lenders and business owners, though change could be coming in that regard. Again, Fed chairman is looking to lower interest rates. Some lenders also noted a deterioration in their respective banks' current or expected liquidity position, as well as less aggressive competition from both banks and non-bank lenders. The slowing of the economy brought on by tightened monetary policy over the past year is likely having some impact on banks' perceived risks, said Elizabeth Renter, a senior economist at NerdWallet. Furthermore, this policy has made it more costly for borrowers to borrow due to higher interest rates. Renter said that for new small businesses in particular, higher rates and stricter lending standards can weigh heavily on their success at a time when financing can mean the difference between surviving the first few years and having to shut down. Though the Fed is expected to be cutting interest rates when they meet next month, business owners shouldn't expect immediate relief. Business owners, especially new ones, should always take care to have plans in place when the going gets tough. While the economy currently looks strong, being prepared for adverse conditions and regularly reviewing your contingency plans should be standard practice. Many lenders are tightening their credit boxes, including banks. We're in less than ideal macroeconomic conditions, and there's a higher cost of capital right now. So, and then let's take a look real quick here at the last article from S&P Global Market Intelligence. So banker optimism on loan growth is higher year over year. So U.S. bankers remained confident on loan growth. And the takeaway here is that basically loan growth expectations increased significantly year over year. Auto loan credit quality concerns increased, and M&A sentiment cooled slightly, and recent stock volatility is unlikely to help. So S&P Global Market Intelligence surveyed U.S. banking industry professionals between June 5th and June 28th and found that slightly over 3/4 of respondents, 75.2%, expect loans to grow with their institutions over the next 12 months. down from 77.6% in the first quarter survey, but up from the 51.4% in the year ago survey. So those respondents expected total loans to grow 5% or more, increased to 17.1% in the second quarter, up from 14.4% a quarter earlier and 11.3% on the second quarter in 2023. In aggregate, U.S. commercial banks and thrifts posted 1% quarterly loan growth in the second quarter, the highest mark since the fourth quarter of 2022. Total loans at U.S. credit unions also increased 1% in the second quarter after contracting for the first time in 13 years in the first quarter. So, and then it goes here, over the next 12 months, do you expect the total value of loans at your organization to increase, decrease, or stay the same? So about 9.4%, slight decrease. Basically 0% saw a significant decrease. About 15.4% said it would remain the same. 58.1% saw a slight increase, and then only 17% saw a significant increase. So, again, I think that, obviously the majority here feels that there's probably going to be a slight increase. I would have a tendency to agree with that. I mean, if inflation continues to decline, and if the Federal Reserve does cut interest rates over the next, say, 9 months, 10 months, we see them bring the federal funds rate down by 100 to 150 basis points, that will absolutely begin to stimulate the economy again. People will get out and start doing deals. Does that mean it's a cure-all? No, because property values have not come down. Like in other words, if interest rates come down, that will help for sure. That does not cure all the problems out there. We have a time where values have not come down, and then all of your expenses have increased or will be increasing. There's a lot of places that are going to be looking to do tax assessments, reassessments, reassess your tax values. So taxes are probably going to go up. Insurance has absolutely gone up. Insurance has spiked in many states across the country. I wouldn't want to be living in Florida right now, I'll tell you that, with their property insurance. And so as a result, again, the lowering of the interest rates will definitely help, and it will definitely begin to pick up. And I think that's why you're seeing a majority of people here saying, yeah, you know what, we see despite the weak demand right now, despite the tightening credit standards, we think at a certain point this will ease up. The Federal Reserve will reduce interest rates. Inflation hopefully will play nice, and then we should start to see some demand pick up probably toward the back half of next year, probably the back half of 2025. So, because you do get a weird, what I would call like psychological thing too, where, when rates are going up, when, back in 22 into 23, when we were in a rising interest rate environment, you have people running in to do deals because they're afraid that the rate's going to go up next month. So they're like, oh, we got to get it done. We got to get it done now. When you have a decreasing rate environment, what do people do? They wait, because they're going, oh, well, if I wait, the rate will be lower next month. And if the Fed is going to be very methodical in doing these quarter point reductions to try to get it down, like I said, 100, 150 basis points. And they do this cutting methodically, like every month for 4, 5, 6, 7 months. Yes, I think you've got a number of people that are going to sit on the sidelines still, because they're going to say, well, why go now when it'll be cheaper in a month, or it'll be even cheaper in 2 months. So I think you'll still see a little bit of that psychology in play, a little bit of that going on, but overall it should help. But hopefully this episode gave people a good idea as to kind of where lending is right now. So basically, demand is really weak. Banks are there. There's a little bit more demand for C&I lending out there. Residential mortgage lending, not that much demand. Commercial real estate lending is dead right now. And basically, you got banks kind of tightening lending standards across the board. So, but they are optimistic that hopefully loan growth will pick up over the next loan demand will pick up, and probably see a little bit of loosening of credit standards over the next year, depending on how delinquency plays into all this. But anyway, If you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please make sure to leave your comments down below, as I love getting back to people. And remember, we are on YouTube, Rumble, and all major podcast platforms. Please check out some of the other episodes that I've posted up either the last couple weeks or this week. And I will be back to everybody real soon. And lastly, do not forget the weekly live stream. Please check that if you have not done so already. But thanks a lot, and I will talk to everybody again real soon.